Turnover ratios tell you how efficiently a company can manage its inventory, collect payments from customers, and pay its suppliers. Our first turnover ratio is the inventory turnover ratio. The inventory turnover ratio tells you how many times a company sold and replenished or turned over its inventory during a period. To calculate the inventory turnover ratio, we divide the cost of goods sold, found on the income statement, by inventory, found on the balance sheet. The higher the inventory turnover ratio, the more often a company is selling and replenishing their inventory. This could indicate the company is generating plenty of sales, but it could also mean the company is not buying enough inventory or is not managing their inventory effectively. If a company has a low inventory turnover ratio, it could imply poor sales, that the company is buying too much inventory, or the company has poor inventory management. How do you know if a company is managing their inventory efficiently? As a rule, an efficient company will have a high inventory turnover ratio and revenue will be growing. An inefficient company will have a low inventory turnover ratio and revenue will be declining. Here we have an example income statement and balance sheet. Let's calculate the inventory turnover ratio. The inventory turnover ratio equals cost of goods sold divided by inventory. Cost of goods sold is 100. Inventory is 200. 100 divided by 200 equals 0.5. That means the company turned over its inventory 0.5 times this year, meaning it did not sell all of its inventory. If you find a company like this, it likely means the company is buying too much inventory or sales have dropped. You could determine this by looking at how revenue has changed over time. When analyzing the inventory turnover ratio, it is best to compare it over time. If it is increasing and revenue is increasing, it's a good sign. If it's decreasing and revenue is decreasing, it's a bad sign. If we flip the inventory turnover ratio, we get the days inventory outstanding. This tells you how many days on average it took the company to turn its inventory into revenue. Days inventory outstanding equals inventory divided by cost of goods sold times 365 days. Our inventory is 200. Our cost of goods sold is 100. 200 divided by 100 times 365 equals 730. It would take this company 730 days to turn its inventory into revenue. The shorter the days inventory outstanding, the better. Our next turnover ratio is the receivables turnover ratio. It measures how many times a company collects its accounts receivable in a period. The higher the receivables turnover ratio, the more times the company is collecting its receivables. The receivables turnover ratio equals revenue divided by accounts receivable. A more efficient company will have a higher receivables turnover ratio. It means they are converting accounts receivable into revenue more often. A low receivables turnover ratio might indicate poor collection policies or customers who are not creditworthy. Let's calculate our receivables turnover ratio. Our revenue is 1,000, but our accounts receivable is 0, meaning this company does not sell anything on credit. Therefore, we can't calculate the receivables turnover ratio. If we flip the receivables turnover ratio, we get the days sales outstanding. Days sales outstanding measures the number of days it would take the company to collect its receivables. The lower the days sales outstanding, the better, as the company is collecting its receivables more regularly. Again, our company has no accounts receivable, so we can't calculate the days sales outstanding. Our next turnover ratio is the payables turnover ratio. It tells you how often a company pays its accounts payable in a particular period. The payables turnover ratio equals cost of goods sold divided by accounts payable. A high payables turnover ratio tells you a company is paying its suppliers quickly, which could indicate that the company is generating sufficient cash flows. A low payables turnover ratio tells you a company is slow to pay its suppliers, which could mean the company is having cash flow issues. A lower ratio may not necessarily be a bad thing, however. It could mean the company has negotiated more favorable payment terms. If it were your business, you would prefer more time to pay your suppliers than less time. Let's calculate our payables turnover ratio. It equals cost of goods sold divided by accounts payable. Cost of goods sold is 100. Accounts payable is 50. 100 divided by 50 equals 2. A payables turnover ratio of 2 means the company paid off its accounts payable 2 times during the year. If we flip the payables turnover ratio, we get the days payable outstanding. Days payable outstanding measures the amount of days on average it takes a company to pay back its accounts payable. A lower days payable outstanding means the company is paying its creditors more frequently. This could mean the company has ample cash flows. A higher days payable outstanding could mean the company is struggling to pay its creditors, but it could also mean the company is taking advantage of favorable payment terms. Let's calculate our days payable outstanding. Days payable outstanding equals accounts payable divided by cost of goods sold times 365. Accounts payable is 50. Cost of goods sold is 100. 50 divided by 100 times 365 equals 182.5. It takes this company 182.5 days on average to pay back its accounts payable. Let's calculate these ratios for Nike. Here we have Nike's 10K for the 2023 financial year. The inventory turnover ratio will tell us how many times Nike turned over its inventory. To calculate the inventory turnover ratio, we need the cost of goods sold and the inventory. Now we should actually be using the average inventory. That's because items from the income statement, such as cost of goods sold, is measured for the entire period. But items from the balance sheet are a snapshot on a single day. We want to compare the inventory for the entire period to the cost of goods sold for the entire period. We can do that by taking the average of the inventory at the end of the last financial year and the inventory at the end of this year. Cost of goods sold is found on the income statement. Here we can see cost of sales, which is essentially the same thing. In 2023, cost of sales was $28,925. Inventory is found on the balance sheet. In 2023, inventory was $8,454. To get the average, we need the inventory for 2022 as well. It was $8,420. We can calculate the average using the formula equals average and selecting these two cells. The average was 8,437. The inventory turnover ratio equals 28,925 divided by 8,437, which equals 3.43. Nike turned over its inventory 3.4 times in 2023. We can now easily calculate the days inventory outstanding, which will tell us how many days on average it took Nike to sell its inventory. We already have the average inventory and the cost of sales. 8,437 divided by 28,925 multiplied by 365 equals 106. It took Nike 106 days on average to turn over its inventory. Next, we'll calculate the receivables turnover ratio, which tells us how many times Nike collected its receivables. We'll need revenue and average accounts receivable. Revenue is on the income statement. Revenue was $51,217. Accounts receivable is on the balance sheet. Accounts receivable in 2023 was $4,131, and in 2022 it was $4,667. That gives us an average accounts receivable of $4,399. $51,217 divided by $4,399 equals 11.6. Nike collected its accounts receivable roughly 12 times in 2023. We can also calculate the days sales outstanding to see how many days on average it took Nike to collect its receivables. To calculate days sales outstanding, we divide average accounts receivable by revenue and multiply it by 365. 4,399 divided by 51,217 times 365 equals 31.3. Nike collected its receivables every 31 days. Next, we can calculate the payables turnover ratio to see how many times Nike paid its payables. We need cost of sales and average accounts payable. We already have cost of sales. It was $28,925. Accounts payable is on the balance sheet. In 2023, it was $2,862, and in 2022, it was $3,358. This gives us an average of $3,110. $28,925 divided by $3,110 equals 9.3. Nike paid its accounts payable roughly 9 times in 2023. We can also calculate the days payable outstanding by dividing the average accounts payable by cost of goods sold and multiplying by 365. 3,110 divided by 28,925 times 365 equals 39.2. Nike repaid its accounts payable every 39 days. Turnover ratios tell you how many times or how often a company will sell its inventory, collects payment from receivables, and pays its payables. By analyzing these ratios over time, you might identify potential troubles, such as decreases in the inventory turnover ratio accompanied by a reduction in sales. In my next video, you'll learn about per share ratios. Per share ratios tell you how much of something you get for each share. Hit the subscribe button to be notified when that is out. For more videos on investing, follow Value Theory or go to valueinvestoracademy.com.